Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, part of our business development team here at iCM, and today I'm joined by Ryan Lehman. Ryan, thanks for being here.
Happy to be here, Pete.
All right, so for this episode of Mic'd Up, we wanted to have a grab bag of topics based on questions we received from the audience. So let's jump in, Ryan. An advisor recently reached out after taking a close look at some of our portfolios and asked if we could talk about quality within the equity allocation. Ultimately, can you start with how you define it?
Yeah, sure. So the way to think about quality is more of a factor than an asset class. That said, though, we do value it like any other asset class: growth value, large cap, small cap, etc. And depending on how those valuations look versus traditional large cap US stocks, we make a decision whether to make a tactical allocation within our portfolios. But just to take a step back and kind of answer your question a little bit more directly and talk about how we define quality, everyone kind of looks at quality from a different lens. Some equal weight sectors, some apply a value tilt. But at the end of the day, there are really just kind of a handful of characteristics that make a company high quality. And most active managers and index providers are going to, for the most part, agree on them to an extent. And just to name a couple of those, they look for low levels of leverage or debt. They look for strong and consistent earnings growth, attractive levels of profitability, think ROE and profit margins. And then lastly, consistent and growing dividends, with that last one not necessarily applying to some of those growthier names.
All right, so can you kind of pause or just move for a second and talk a little bit more about the risk and return characteristics of the asset?
Yeah, sure. So one of the longest tenured proxies that we have out there for quality is going to be the S&P 500 Quality Index, and that goes back about 30 years. And if you look at those results compared to the S&P 500, you're going to find that returns for the Quality Index are actually superior, with the Quality Index outperforming on an annualized basis by about 300 basis points. And the way you get there is really through quality stocks acting as a ballast during periods of market stress. And I guess the question is, why does this occur? And if we think about those characteristics of quality stocks that I just went through, I think it makes a lot of sense. When markets are volatile, it should be those less levered, more profitable companies that are going to hold up better because their business models are going to be less at risk. And that's precisely what you see in practice. If you go back to 1995, the quality index, it's giving you an up capture of about 97%, so just a tad behind the S&P 500. But it's also displayed a down capture of just 81%, which is going to clearly illustrate its defensive nature.
All right. So, what about in this case? What about valuations? As most watching this video know, all the decisions we make are ultimately driven by valuations across asset classes.
Yeah, well, on an absolute basis, quality stocks have historically traded at a premium to broad U.S. large caps. And if we think about that intuitively, it makes sense. You're paying a premium for those strong balance sheets and that attractive profitability and earnings. But what's more important to us is the relative picture. So how does that valuation relationship versus large caps look versus its long-term average or its fair value? And what we find is similar to what you see with most asset class relationships. The more stretched valuations become, the more attractive future relative returns have been. But I think the one really interesting nuance with quality is not only has it shown an ability to provide attractive returns from just cheap valuations, but quality stocks have also done really well from just levels of fair value.
All right. So the $64,000 question here, where do we sit today?
Yeah, well, with performance being pretty strong over the last number of years, you've seen valuations kind of sitting in that fair value range recently. So not cheap, but not really expensive either. So they continue to act as a core U.S. equity holding across most of our tactical ETF and mutual fund strategies. And this has really served us well, especially through 2022 and throughout the volatility that we've seen so far this year. And even with valuations kind of sitting in that fair value range, we do continue to be pretty bullish on the asset class, especially if you're in the camp that believes that economic and earnings growth may start to slow down a little bit as we get later on into 2025.
All right, so good stuff. Let's pivot to question number two. And when we just got this one last week, so from an advisor, they reached out concerned about the recent downgrade of the U.S. by Moody's. What, if any, impact do you see occurring from this?
Yeah, so besides it not reflecting well in the US, I think it's not really telling the market anything new. So we already know that we're running an unsustainable budget deficit. We know that our debt to GDP is a little bit too high, especially when you compare it to other developed nations. So this announcement was really just one of the major ratings agencies making their concerns official. Now, it did have a little bit of an impact on equity markets. So you saw US stocks selling off by about 2.5% in the week that followed the announcement. But I really think over the longer term, the impacts are going to be more felt in bond and currency markets. So let me go ahead and start with bonds or rates. So U.S. Treasuries are viewed as a risk-free asset, largely because their interest and principal payments are going to be backed by the full faith and credit of the U.S. government. But kind of that aside, even though a default down the road is really highly unlikely and would be catastrophic for both equity and bond markets, concerns over the credit quality of the US government, it does put upward pressure on interest rates. It's no different than taking out a home or an auto loan. The lower your credit score, the higher your financing rate's going to be. And we've seen this reflected in rates markets already, not just since the Moody's announcement, but for really much of the last year. So if we look back to last September, you had the yield on the 10-year US Treasury trading around 3.6%, and you had the 30-year trading at less than 4%. Now rates for both of those bonds are about 100 basis points higher today. You've got the 10-year trading near, say, 4.6%, and then you've got the yield on the 30 around 5%. And another place we're seeing kind of evidence of this is in what's the so-called term premium, which is a little bit difficult to measure in practice, but in simple terms, it basically just measures the extra yield that investors require to own longer dated bonds over shorter dated bonds. Now, the Federal Reserve Bank in New York, it does have a statistical way to measure this, which I'm not going to get into the weeds of the details here because it's a little bit abstract. But if we look at the trend in that metric, it's clearly been upward. So their most recent estimate is just over 80 basis points for the US 10-year Treasury. And this is actually the highest level, or just about the highest level we've seen in the last decade or so.
All right. So what about the dollar and all of this?
Yeah, sure. So similar to treasuries, the dollar is considered a safe haven among global currencies, and it's viewed by most as the reserve currency of the world due to the overall stability of the U.S. government and our relatively good financial situation. Now, we would have to see a meaningful shift for the dollar to lose its status as a reserve currency, which pretty unlikely. But just like interest rates, if our financial situation starts to be called into question, it does potentially make the dollar look less attractive as that safe haven asset. And that's essentially what we've seen for the last 5 months or so. So from its high back in January, we've seen the Bloomberg Dollar Index sell off by about 8%. And then in addition, we've seen really this unprecedented demand for gold, with the precious metal hitting an all-time high just a few weeks ago, and its price rising by more than 20% this year.
Okay, great stuff, Ryan. Let's hit the third question that's been submitted. Can you talk about how you select closed-end funds within TICE and TICE Alpha Ops or TAO, and how do you use so many unique holdings within the portfolio?
Yeah, so let me start by explaining what we don't do. So unlike many closed-end fund ETFs and indexes, we don't just simply buy closed-end funds that are trading at the steepest discounts, because some, if not many of those funds may be trading at steep discounts for a more fundamental reason. And for that matter, they may persistently trade at steep discounts, meaning that the likelihood of those discounts becoming more narrow could be pretty low. Instead, what we do is we look at closed-end funds the same way as we look at asset classes, through the lens of relative valuations. Essentially, what we're doing is establishing a fair value discount for every closed-end fund in the universe, and then identifying the funds with the highest probability of their discounts reverting back to fair value. And when we can't find enough closed-end funds to fill out the portfolio, we'll just use low-cost ETFs to keep our powder dry while still getting that cheap market exposure.
All right, so you said something interesting about filling out the portfolio, which kind of circles back to really the second part of that question. What's the team's rationale for owning such a diverse basket of funds versus just assigning or owning them in higher weights to funds with bigger discounts?
Yeah, so there is a very specific rationale for that. Essentially, what we don't want to do is introduce manager-specific risk into our strategies, which is possible when you start taking more concentrated positions. Instead, the goal in our closed-end fund strategies is to build a broadly diversified portfolio of many funds at relatively small weights that when you take them all together, it gives you essentially a market portfolio. And then what that leaves you with is really three sources of return. You get the price appreciation that you're going to get from the asset classes you own. You're going to get that enhanced level of income that closed-end funds just tend to generate naturally. And then lastly, that unique return source, closed-end fund alpha, which is that additional return you receive when discounts narrow back toward fair value.
Great, Ryan. I want to thank you for stopping by today and covering these questions that were submitted. And if you do have any additional questions on the content we covered today, or would like to suggest a topic for a future episode, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.